Hi, I'm Bill Wilt of Assured Research. Thanks so much for joining this short video where we'll focus on a research note. It was part of our February Assured briefing. If you're a subscriber to our work, you will have that briefing, and we hope you have the chance to read or skim the entire document, but this note in particular. And if you're not a subscriber, you're watching this video, thanks. Hope you get some benefit from it. And please do feel free to reach out to us for a trial to our work. So with that, bear with me just a second. I'll share the screen and we'll get started on this research note focused on, there we go, focused on earnings expectations for 2024. Okay. Okay, good. Slideshow. Okay, so this is a useful time of year. Here we are in early 2024. January is when this is being recorded, and it's a useful time to look at the earnings expectations for the current year. That is because they contain or informed by kind of sort of the maximal amount of information that analysts are going to get on publicly traded property casualty insurance companies. And yet we haven't experienced that. First quarter results haven't been reported, and it just becomes harder to tease out actual versus expected results as the year starts to be shaped by actual results, not just expected results. So probably the maximal time to look at 2024 earnings will be after fourth quarter earnings conference calls are held. We'll do that, but from where we sit right now, it's very useful to look at 24 and 2025 earnings expectations. This shows operating ROEs historically plus ROE expectations for 2024 and 2025, specifically with a focus on the spread over treasuries. This kind of gets right to the point of, hey, are insurers meeting, beating, or falling short of their cost of equity, where you can reasonably think that the equity risk premium, that is the spread over the 10-year treasury, might be in the, call it 6 to 8%, 8 to 10% range, depending on your perspective. That level of range over the treasuries, probably 6 to 8% as I think it through. And here you have the long-term perspective. Lots of variability, mostly a result of catastrophes, as you might expect. Some from the pricing cycle, and importantly, if on the pricing cycle, if you look at 2024 and 2025, you see spreads over treasuries of 12-ish% that are expected. And that would include normalized catastrophe years, which for most companies is catastrophes that maybe call it anywhere from 3 to 4 to 5 or 6% of premium, depending on the orientation of the insurance company. So what we're looking at is peak earnings in 2024 and 25, arguably peak, that compare quite nicely to the last peak in 2006 and 2007. Now that was when earnings were benefiting from they call it the 9/11 hard market. A lot of favorable reserve development was starting to come through the income statements at that point. Plus, with very difficult cat years in 2004 and 2005, property cat pricing firmed really sharply in 2006 and 2007. So there's a saying that we believe, I think it's kind of consensus thinking, that the earnings cycle follows the pricing cycle, and there's still debate on whether the pricing cycle is over or exactly what inning we're in, but clearly investors expect good earnings years in 2004, 2005. Let's focus on written premium growth, which provides some insights into the pricing cycle. And what we've done for this research note is look at publicly traded companies, 25 to 30 of them, and we've broken them into personal insurers, standard and specialty commercial, and reinsurers. The cohorts aren't perfect. There are very few. There are a few personal insurers that just do personal insurance, but Standard versus specialty, obviously judgment, reinsurers. There are very few, if any, pure reinsurers. Virtually all are a combination of insurance and reinsurance. So acknowledging that the cohorts aren't perfect, they never can or will be. Pardon me. We did our best, and here's what you have. Um, Quite frankly, it's tough to tease out a lot from this for personal insurers. That's the line, the blue line. Um, Clearly, analysts are expecting that 2003 will have shown peak premium growth. We all know the story, especially auto, homeowners insurance, a lot of rate increases going through because of catastrophes. Auto, clearly, the pandemic, post-pandemic story, auto insurers pushing through the maximum rate increases they can get past regulators. Investors expect most of that to have come through in 23. The rate of premium growth will expected to decelerate in 24, although earnings, if we were looking at earned premium, there might be more parity between those two lines. And even 25, you'll have some companies, especially those that offer not 6-month, but only annual policies. A lot of insurers offering annual policies have made it clear that they're going to need to continue increasing prices into 2025. So that story is still playing out. Standard and specialty commercial, not a whole lot there that's maybe particularly notable or interesting, other than if you look at 2025, you see that there's an expectation that the growth differential, with specialty having grown faster than standard commercial for many years, you see there's an expectation that growth differential will shrink, and clearly analysts are expecting that for reinsurers, 2025 will represent more of a normalized year. The rate of premium growth probably depends quite a bit on what happens with catastrophes in 2024 and casualty reserve development and so forth. But still, they're thinking that the peak pricing cycle will be passing by 2025. And I think that's probably the main takeaway, is that analysts are expecting that 2025 is going to be kind of a normal year for premium growth. When we look at loss ratios, median loss ratio, you see really sharp improvement expected for personal insurers. That'll be influenced by catastrophe vis-a-vis kind of normalized cats that are baked into the loss ratios for 24 and 25. But the real driver there is clearly an expectation for improving auto results. Probably less really notable content or information content for standard versus specialty. You see some slight expected improvement over 23, 24, and 25 for standard. Kind of whole, but we characterize it in the words on the right there as standard and specialty holding serve. Not a big change in expected in their low 60s type of loss ratio. Notable for reinsurers, however, that analysts are expecting that 2023 was really kind of a banner year, not to be repeated. Our guess would probably be that much of the increase from 23 to 24 is not a change in terms and conditions or even rates, but rather just an expectation that we'd return to a catastrophe pattern that had more of a mix of lower grade and moderate sized catastrophes and a few severe catastrophes. 23, of course, characterized by heavy catastrophe losses, but a lot of them from severe convective storms that just didn't pierce the property cat reinsurance attachment points. So a lot of the cat losses were pushed onto primary companies. 24, 25, there'd be an expectation for more balance between severity versus frequency of catastrophes. The expense ratio is interesting in that it doesn't show much. So what we take away from this is that analysts aren't expecting nor building in any artificial intelligence fueled improvements in the expense ratio. In fact, across 23, 24, and 25, you see them, virtually unchanged for each of the cohorts that we're looking at. And although it's not shown here, in other research, we've shown multiple times over the years that the industry's expense ratio really hasn't changed since the late 1970s, which is kind of incredible when you think about all the technological improvements that have taken place over that time period. So we continue to think that from a very macro perspective, that the property casualty industry really has a lot of room and should feel some imperative to improve their expense ratio on behalf of policyholders, personal and commercial. It was difficult to compare the anticipated growth in investment income as we had on other slides with other variables for across these cohorts for investment income. There's just a lot of variability in the way investment income is reported and captured, and we didn't feel like the comparisons would be really kind of apples to apples. But what we're doing here is we show the 10-year Treasury yield, and if you'll just allow, you kind of look at this rapid increase from 21 to 23, expected to hold in 24 and start to come off, and slightly in 24 and more in 25. You factor that into the duration of most fixed income portfolios, kind of sort of in the 3 to 4 year range for most property casualty insurance companies, and considering that they're even in heavy cat years, they're typically generating new cash flow. Bottom line is we think that kind of 22 to 2024 will represent the fastest growth in net investment income. And after that, the growth in net investment income really should start to should decelerate and start to stabilize, assuming that interest rates come down but don't fall back down to the kind of low 2% range where they were in the pre-pandemic era. So that's investment income. This is an interesting. We're going to jump ahead to returns. This coefficient of variation is interesting. We think. Remember, coefficient of variation is the standard deviation. In this case, we're using returns on equity. Standard deviation of returns on equity divided by the mean of return on equity, just to allow for comparisons across cohorts. Standard deviation, a measure of risk, variability. The denominator, a measure of the mean ROE, so return, absolute level of return. So with that measure, lower is better. And look here at standard commercial. So we say in our research note that although it's a very mundane moniker, standard commercial, that nobody much likes, they've actually, from an investment perspective, or I shouldn't say from an investment, from a performance perspective, they've done the best, the lowest level of variability in relation to the return that they've operating return on equity that they've offered, this being measured from really century to date, 2000 to the 2023 full year expected results. Not surprisingly, reinsurers, because of the variability in the cats and property cat, the nature of the business, they have the highest level of variability, and especially in personal commercials, commercial insurers, not so different. When you look at operating returns by business concentration, if you look at 2022 and 2023, you can barely see the blue line, and that's because personal insurers, net of everything, didn't earn any meaningful return on equity. That, of course, is expected to change, and investors, I think it's fair to say, would be pretty disappointed if that didn't improve meaningfully in 2024 and 2025. With standard and specialty, you've seen the peak ROE in 2024 and falling off, and likewise for reinsurers falling off. We suspect that, again, is, as described before, this return to a pattern of some mix of frequent, moderate-sized catastrophes may be retained by primary companies with at least some severe catastrophes, maybe a landfalling hurricane or two. Also, our sense, intuition is that analysts are expecting that some of the industry discipline, if the industry reinsurers that is earn, 20-ish% ROEs for 2 consecutive years, probably safe to bet that some of the pricing discipline will break down, and you see some relaxation of prices and even perhaps terms and conditions that will bring that ROE back down more in line with that of the primary companies. So that's what we had for you. I hope you enjoyed this brief summary of of this note in our February briefing, which has lots of other we think we're biased, interesting research notes. So we hope you check it out if you're a subscriber, and contact us if you're not and you'd like a trial. So thanks again, and have a great rest of your day.